per share, which is 8% a year. If you go on Yahoo, this has a dash for their dividend. It doesn't even show a dividend. The thing is, this company doesn't need to advertise. I've been following this company for 20 years. And they also have a Christmas bonus dividend. And they don't announce it, they just pay it. But they don't advertise on Yahoo or Google. So you won't know unless you call your broker. Okay, StockSplitHistory.com is good because it'll tell you the stock splits. If you look up Netflix had a 7-for-1 and they had a 2-for-1. 7-for-1 I think was, I want to say, this is 18, I want to say 2015. And then 2-for-1 I think in 2012. Don't quote me. Doesn't matter. The point is, they had two nice stock splits, 2-for-1, 7-for-1. And the chart's going straight up. So this is a star. These guys, Netflix, they got a star. Apple has 7-for-1. They just had a 7-for-1. 2016, I think, give or take. That's awesome because you get 7 times your shares. Now the price goes down 7 times, so you don't make money that day.
Right.
But when you have a share for $700 and it's split 7-for-1, you have 7 shares at $100. Okay. So the magic of stock splits is this: what happens to the stock is it attracts investors at 100, and they think we're going to split again in the future. Let's get it. So the stock it has a nice split. So then they get it at 100, and what happens? The share price goes right back up to 700. Let's say after a few years. So you multiply your money times 7 is what happened. And then what happens? They do it again. 7-for-1 stock split. That's all you need for a stock to shoot up in one day. Netflix announces 7-for-1 stock split. We go crazy.
How come Amazon and Google hang on to their shares without splitting?
It's cool right now not to split to get a higher share price, but Amazon split and so did Google.
Yeah,
Google split.
but
Google
not
got
recent.
GOOG. It was $1,000. It's split to 500. Now it's $1,000 again. Just what I said. It's $1,000 again. Went right back to the price where they split. So Google and Amazon do split. They just take more time. They like the share price to get higher before they split. Okay.
But so, what do you think splitting like an Amazon, like let's say a 7-for-1?
I think that's going to come in the future. And I think it's going to split again, and we're all going to be very happy who have the shares. But I can't tell you when.
But don't you think, I mean, if it were to split, let's say, 7-for-1, then that price drops down to
I can make a forecast.
a couple of $100, $150. Doesn't it allow, smaller accounts to start trading that stock?
Yeah, I'll make a forecast. Amazon is $14.95 today. When the stock gets 2,000, it'll split 2-for-1. That's my forecast. So get in now, right away to 2,000. Expect 2-for-1 split. It'll be 1,000, and you'll have double your shares. It already did this, by the way. I'm going to say in 2013 split. Look at stock splits history. And then what's going to happen is it's going to go right back up to $2,000. And then it'll split again. So if you look at Coca-Cola or Microsoft, the original godfathers of the market, they've had like 10, 20, 30 splits, some of them. And if you look at how much money you would have if you just held the stock and withdraw all the stock splits, it would be exponential. So the teaching is get a stock that does stock splits. That's what you're looking for. You're not looking for some crappy penny stock that's valued at $2. You can buy a lot of shares with no premium, no employees, no stock splits. You want stocks that's already split. Apple, Google, Amazon, Netflix. Nike has some good splits. We're good at Nike splits right here.
Visa too, right?
Visa, yeah. So, get a stock that has stock splits because they'll keep going, okay? And number 5, what else do we want to cover?
I bought Visa when it went public. That was years
Visa
ago.
when public was great, it's still doing great, and so is MasterCard. And my advice is to buy both of them. They'll do another split. Visa's 119 right now. I think.
Like one, yeah, right around
Options. Let me do options. Buying. We're going to do buying calls. Now, when you're buying calls, I don't want you to do a small percent of your account. 5%, maybe 10%. Small amount of your account. Don't put your whole account on option because it can go to 0. Option can go to 0. I'll tell you right now. Okay? When you buy it. So, the way you do it is, let's say you have Netflix. 300, okay? Wait, let's do Twitter. We did enough Netflix. Twitter's 3103. So we're gonna look out. We're gonna go out 3 months to June. April, May, June, 3.5 months. And we're gonna look at the strike at the money, right? So $31, so 31 call. 31 call is 345 or 350. Let's say 350. Okay. So we're gonna go June, which is 3.5 months out. Don't go 1 week, 2 weeks. That's high profile gambling. Better just to like throw it on craps because at least you get free drinks. Nice cocktail hosts, you know. If you're gonna gamble, you know. So go out 3 months, 6 months, you can do the lead. But in this case, we're gonna go 3.5 months to June. The 31 strike is 350 per contract. So you're taking $350 for by one call. Stock is still over 50. So you're getting, it's costing you like how much? Like just over 10%. You're going to control 100 shares.
What strike price is that?
31 strike. 31 strike.
So you're buying it in the money?
In this case, you're in the money 3 cents.
Okay.
I like to buy at the money, slightly in the money, but if you're buying, like, look, people, this is what people try to do. They're trying to buy, oh, we're going to buy 40 call. And it only costs 80 cents. The problem here is, if we start moving towards the expiration date, and the stock has not moved up, this 80 cents will be 0.
Right.
So, this being close to the money has more value. It won't go down as fast. It's protection. So spend more money on the call. Don't buy 80 cents, buy $3. That way, you're buying a stock that's more in the money, has more value. 80 cents is just smoke, you're buying smoke. People, I've seen a stock for 5 cents, an option for 5 cents people buy. It's like it's a pipe dream. You know, the only way it's gonna make money is if it swings up and they gotta sell right away. If they'll sell right away, it's gonna go back to 0. So look for like $2, $3 calls or more. If you buy Amazon, it'll be Netflix, $30 calls. Amazon, $50 calls. You know? So the least money you spend, the higher risk it is, higher reward, but you're already risking because you're buying something that's going to devalue to 0 at the expiration. So you better spend more money.
What's an Amazon call at the money?
Well, we wrote the call for 50, remember?
But that was out of the money.
Right. So inside the I'll tell you right
It
now.
was like $100.
So let's say when I buy Amazon, 1450, let's say 15 strike. So you go out to June.
15.
We're not going to do April. We're going to go out to June.
Okay.
So more time, more money. $1,500, $108.
So
Which
like
is-
$11,000.
10,800. 108. Now, rather you spend 10,000, you get a solid call, 1,500 strike for June on Amazon. They try to buy something for 80 cents.
But now your break even would be 616,
It has to go up
1608.
14.95. If you buy the 15, it has to go to 1608. Right. But let me tell you something. Here's where you actually break even. Because it's going to be 0 at 1608.
So it has to be a
So,
nice swing.
I'm sorry. Cancel that. No, you're right. At 1608, your option, your 108 option is going to be 108.